what's going to happen is the same thing that's happened in the past, is they have hiked too far. And then you know what they're going to do? Just like when they hiked too fast last year in response to waiting too long, they're going to cut really fast. They're going to be cutting rates in response to this collapsing U.S. economy by later this year and into next. Next year is also an election year, Andy, here in the U.S., presidential election. The beginning part of next year, you're going to get, Elizabeth Warren and Bernie Sanders and all these politicians. What is going on? How come you're keeping rates so high? The economy's in the tank. It's, cut. And as soon as that goes, as soon as we're recognized in that period again, that's when gold's going to break out, and that's when silver's going to break out.
Craig Hemke, the creator and publisher of the TF Metal Report, a blog and online community about the inevitable end and failure of the Great Keynesian Experiment, believes gold and silver are right on track for a massive price breakout in 2023. Craig, who is often fondly referred to as Turd Ferguson among the members of the TF Metals community, expects both leading precious metals to begin to see massive price gains later this year when the U.S. Federal Reserve finally begin to see the errors in their way and reverse the economy-breaking policies of the past year. During a recent discussion with famous British commodities trader Andrew Maguire, Craig discusses his outlook on the United States economy and how the ineptitude of the Federal Reserve is wreaking nothing but havoc on the economy. Craig and Andrew, both strong believers in the use of precious metals as the only sure source of wealth preservation, caution U.S. investors and investors everywhere in the world against recency bias, especially when analyzing the strength of the United States economy, the dollar, and the changing geopolitical dynamics in the world. While many people are so falsely lured to believe there's nothing wrong with the system, Craig and Andrew highlight and analyze exactly why it is almost completely broken, no thanks to the Fed's monetary policies. Andrew describes officials of the central bank as self-serving bankers with no actual interest or experience in making sustainable policies for the economy and the benefit of Americans. Craig also reminds us about the many false narratives they put out about inflation in 2021, insisting it was transitory until it was too late to take necessary precautions. As if to make up for their slow reaction and ineptitude then, they are now hiking too hard and too fast without regard for how the economy is actually faring under the bludgeoning effect of their sledgehammer. Whatever the outcome will be, Andrew and Craig believe it will be a win for precious metal investors because when they finally begin to cut rates, gold and silver prices will see massive price gains. During the discussion, Andrew and Craig also discussed the banking sector crisis and the many indications that the next phase will be bigger than anything we've ever witnessed in U.S. history. We will now bring you clips from the discussion between these two precious metals enthusiasts. Ensure you watch the video to the end, subscribe to the channel, and smash the like button for more content like this. Also, ensure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and significantly contributes to the channel's growth. Thanks and enjoy the video.
In the U.S., and really globally, but particularly bad in the U.S., people have a real bad recency bias. They've never known a world where the dollar wasn't the reserve currency, where the U.S. wasn't one of at least two, superpowers that could do anything they want. And so you just naturally assume it's always going to be that way. Our financial education over here is horrible. You mentioned people thinking that the Federal Reserve is somehow part of the U.S. government. And in fact, you'll even hear, whether it's people on the street, people I know, or people in the media will say, the next time the Fed hikes rates, they'll say the Feds hiked rates today. The Feds, as if the government did it, right? But as you know, and as most people know, they have nothing to do with the actual government. Though Powell, when he'll give a speech, he'll have the flags behind him, like he's the president. They treat these people as if they are these omnipotent, demigods, when they're no more qualified to do their job than you and I would be. Most of them have never had a job outside of the Fed. Like they parade this goon, this Bullard from the St. Louis Fed on CNBC and Bloomberg and the like a couple times a week. 37 years that cat has worked for the Fed. Has never worked anyplace else. And so what these guys do, they are political, nonsense, and they kiss a little ass here and kiss a little ass there and get promoted up the channel. And all of a sudden you end up head of the whatever reserve bank. And all they do is read the research reports. They have an army of economists and statisticians that crank out all these reports based off of certain models where, oh, in the past X number of times we've done this, the economy has responded that way and the like. And that's where they're in a real jam this time because, yeah, there have been hiking cycles in the past, but never like this. They all fooled around for 2 years after printing $5 trillion in COVID, saying inflation was transitory. When you and I and anybody with, an objective thinking brain knew it wasn't transitory. And then they tried to blame it on, well, the supply chain disruptions and all. No, it's too many dollars chasing too few goods. It's a traditional definition of inflation. Oh, but don't worry about it. It's going to go away. Don't worry. I mean, even Yellen, all of them played this game. And in doing so, heck, Andy, I mean, it was only 18 months ago that the official statement from the Fed was that they weren't going to be hiking rates until 2023. It was late 2021. No hikes until 2023. Now here they're trying to tell us that there are going to be no cuts. Who believes? Why would anybody believe them? They don't know what they're doing. They're just, like I said earlier, they're just kind of making it up as they go. And so they set off, because they get behind the curve with inflation, they set off on this course of hiking at a pace they've never done before. The yield on the U.S. 2-year note's gone from 0% to 5% in 15 months. Credit card interest, highest it's ever been. Mortgage rates have more than doubled. I mean, the ripples across the economy have been profound, but yet they've never done this before, so they don't know what they're doing. They don't, after 6 months of this, then we should expect, no, that doesn't apply here. And so they keep on hiking, even though they don't really know what the economic impacts are, just because, well, the latest jobs report, which is nothing but statistical guesses anyway, sure looks strong, so we better hike again. What's going to happen is the same thing that's happened in the past, is they have hiked too far. And then you know what they're going to do? Just like when they hiked too fast last year in response to waiting too long, they're going to cut really fast. There's also an election year, Andy, here in the U.S., presidential election. You think these political animals, creatures, whatever you want to call them, at the Fed, they like their job. They like their cushy speaking appearances. They like, to be able to retire and go to work for Citadel like all the other Fed goons, make a couple $1 million a year flying around their Gulfstreams and everything else. They don't want to lose their jobs. So by the beginning part of next year, you're going to get, Elizabeth Warren and Bernie Sanders and all these politicians. What is going on? How come you're keeping rates so high? The economy's in the tank. It's, cut.
According to Craig's analysis, next year's presidential election will soon have politicians from both sides of the aisle scrambling to get back in the good graces of voters. They are not going to be able to do that if interest rates are still so high. So they will inform their stooges at the Federal Reserve to become as dovish as possible. Craig believes this will be very great for precious metals prices. However, he warns precious metals investors to hold on tight, as the manipulators will do everything in their power to keep prices down so they can continue their unchecked and even encouraged manipulations of precious metals prices. Regardless of what happens in the coming months, Craig says to hold on to your gold, silver, copper, and others for dear life. If you're selling, someone is buying, and you don't want to be without the protection those metals will bring when everything hits the fan. Let's get back to the interview as Craig and Andrew discuss the next phase of the banking sector crisis and the ultimate goal, the introduction of central bank digital currencies.
By crikey, one of the things that really gets my attention is the banking crisis that claims to be over.
Yeah.
And of course, it had nothing to do with the Fed raising interest rates rapidly and not stress testing any of the banks. No, nothing to do with that. What the hell's happening over there? To me, it doesn't look over.
Yeah, funny, Andy. We have had here in the U.S. the second, third, and fourth largest by assets banking failures in history in a 6-week period in March and April. The second, third, and fourth. The only largest one was Countrywide, which was back in whatever that was, the financial crisis of 2008. And yet everybody thinks that's just some isolated incident. We have, you may be familiar, and global listeners may have heard the term FDIC before when mentioned with the U.S. banks. That's what we call our Federal Deposit Insurance Corporation. It was invented back after the Great Depression as like a government fund that all the banks pay into to insure deposits. And it's, I mean, woefully undercapitalized. You know, it's like just a little bit of money for like one or two banks if they go under, so that then everybody gets made whole and operations can continue, that kind of thing. Well, whatever. The FDIC puts out a report every quarter on the state of the banks that they watch. And they've got a thing called the problem bank list. That sounds like, that sounds very benign, doesn't it, Andy? These are our problem banks. Anyway, at the end of the fourth quarter, there were 4 banks on that list with a total of $10 billion in assets. At the end of the first quarter, there were 43 with $60 billion in assets. Now, this is primarily brought about by, the change in interest rates, which the Fed is, after all their transitory crap for 2 years, is now hiked rates at a pace they've never done before. So they don't really know what they're doing. They're just kind of flying by the seats of their pants thinking, well, we got to hike rates now. So all these banks are underwater, even with the accounting changes that came out after the great financial crisis. And that's just the kind of the tip of the iceberg. The other thing going on over here, Andy, that I would imagine is global too. Maybe you can address what, they discuss in the UK, but commercial real estate is a major looming problem here with vacancies and, businesses going out of business, businesses downsizing their office needs. And the primary issuer of credit to mortgage or to credit, or people that are out there trying to develop properties and stuff, are the local banks, the local and the regional banks. They carry something like $3 to $4 trillion worth of commercial mortgage debt. So there are a whole bunch of problems that are either still percolating or are bubbling just below the surface. And this notion, and it's really put forth by the financial media that has an interest in kind of keeping the plate spinning. This notion that everything's fine. Oh, don't worry. Oh, yeah, we got it all in control. The Fed's omnipotent. That Silicon Valley Bank thing, all that other stuff kind of came from nowhere back in March. I mean, those headlines could pop up again anytime, and I certainly will before too long. It's driving a consolidation in the banking sector. Like you said, and as I mentioned earlier, all of this commercial stuff is done at the local level. Like it's a lot of handshake deals, that sort of thing. And it's driving the consolidation into, again, who bought the most recent round of banks, JP Morgan. And what is their primary business? Credit cards and proprietary trading, right? They're not really at the local level getting to know you, that sort of thing. And so you're getting this consolidation. What eventually it leads to is the introduction of the central bank digital currencies, which, for all of us that own physical metal or participate in kinesis, I mean, we're all kind of, getting prepared for that sort of thing in the first place. You got to control your own sovereign, territory with your own physical sound money and access to it immediately. This war on cash has been building now for a couple of decades. And the ultimate weapon will be this central bank digital currency. Now, to me, Andy, it's going to be rolled out in a response to this crisis as it comes.
Federal Deposit Insurance Corporation released its quarterly banking profile a few weeks ago. The report found that U.S. banks lost $472 billion in deposits in Q1 2023. The decline is the largest ever recorded since 1984, when the FDIC first began collecting quarterly industry data. It also marked the fourth consecutive quarter of outflows from the banking industry. During a press briefing with reporters, FDIC Chair Martin Gruenberg said, "The more lasting effects of the industry's response to that stress may not become fully apparent until we've received the second quarter results." The report contained 2 important charts that show the true health of the banking sector in the United States. The first is the quarterly change in deposits, which has steadily decreased for 4 consecutive quarters. The next is the chart showing the increase in the number of the FDIC's problem list, which contains the names of banks that have multiple weaknesses identified by regulators and can be seized and shut down unless the issues are resolved quickly. According to the report, there are 43 names on the problem list with a combined asset worth $58 billion. In the report, the FDIC chair noted that there are lots of issues that could continue to negatively impact the banking sector in the coming months. A part of his statement reads, The banking industry continues to face significant downside risks from the effects of inflation, rising market interest rates, slower economic growth, and geopolitical uncertainty. Commercial real estate portfolios, particularly loans backed by office properties, face challenges should the demand for office space remain weak and property values continue to soften. Do you think we've seen the end of the banking sector crisis as regulators would have us believe? Let us know what you think in the comments section below. Also, ensure you drop your thoughts on Craig and Andrew's discussion, smash the like button, and subscribe to the channel for more precious metals content. Thanks for watching.